The S&P 500 just tanked over 10% from its recent highs, and if your portfolio is plummeting right now, trust me, you're not alone. Daily tariff threats, stubborn inflation, and whispers of shaky economy. It's chaos out there. I know it's got a lot of you asking, should I sell, hold tight, or keep buying? Well, here's the good news. You don't have to guess. In this video, we're slicing through the noise. No hype, no panic, just a straight up truth about surviving volatile markets like this one. Stick around to the end because I'll also pull back the curtain on my own portfolio, revealing the ETFs and stocks I'm buying up right now. Let's dive in. Here's the truth you won't hear when the headlines scream crash, and it's something every investor needs to know. Stock market corrections, bear markets, even full-on crashes, they're normal. Not rare, not apocalyptic, normal. Let's break it down. With nearly a century of data since 1928, corrections, drops of 10% or more, hit every 1 to 2 years. Bear markets, 20% or worse, roll in every 6 years or so. So yeah, 2025 has been a roller coaster, but this isn't some freak event. It's how markets work. I know you're still jittery about what's happening, but check this out. Every investor needs to see it. After 2008's 57% plunge, the market soared 69% in 1 year, then 300% in 5. COVID's 34% drop, up 75% the next year. Even 2022's 25% dip bounced back 22% within a year, and the stock market hit all-time highs again in 2024. The takeaway, markets tank in the short term, but they always climb back over time. Investors who stick it out, they're the ones who win big. Ever sold in a dip and kicked yourself later? I know I have. Let me know in the comments and I'll share my story as well. I get it. Investing when the market's nosediving is brutal. Everyone says be patient. When your portfolio is shrinking, it's not just numbers, it's emotional. I've been there. Back in 2022, one of the wildest years in a while. I thought I was smart. I bought the dip, but then the market kept falling. I sat there wondering, did I jump too soon? Should I have waited? What if it tanks even more? If you've ever felt that, you're not alone. But here's the hard truth, and it's a game changer. You can't time the market. Not me, not you, not even legends like Warren Buffett or Peter Lynch. Buffett once said, the only value of stock forecasters is to make fortune tellers look good. Translation, predictions are a coin toss. Even Buffett with his billions admits he can't call the market's next move. So why should we think we can? Here's the kicker. Some of the best days in market history happen right after the worst. Data shows missing just the 10 best days over 20 or 30 years slashes your returns in half or worse. Think about that. If you're sitting on the sidelines waiting for the perfect moment, you'll likely miss the days that turbocharge your wealth. And nobody, not even the pros, know when those days will hit. They often come when fear is peaking, right after a brutal drop. I want to bring in Tom Lee, one of Wall Street's sharpest minds. When asked if now's the time to buy, here's what he said. It's short, sweet, and something every investor needs to hear.
Investors often have to place their bets before something takes place. Is this a buy, this unsettled market that we've witnessed recently?
Yes. In my mind, we put out a piece yesterday just talking about the 10 best days that happen every year. Last year, for instance, the 10 best days added up to 21 percentage points of the S&P. X those 10 days, the market was only up 4%. So, you don't get 20% years because it's good through the year. It's just the 10 best days. I think the setup for a 10 best day is near because if the economy's near stall speed, I think people realize the Trump put does come back because otherwise it has to unwind all this austerity. And if the job market's soft, the Fed put comes back into play because the Fed doesn't want to play with stall speed. And I think that's what is going to be the positive catalyst in the next couple of weeks. And on top of that, we already know stocks will bottom before bad news peaks. And so if we're seeing the market not fade on bad news, that means we're already priced in a lot of things that would scare us.
Tom nails it. The biggest gains often hit during the ugliest markets, sometimes in just a handful of days. So we've covered why crashes are normal and timing's a myth. Now the big question, what should you do in this market? It depends on your situation. Let's break it down. If you're in a solid spot, earning more than you spend, got some savings, and don't need this cash soon, keep investing. Better yet, ramp it up. Why? Because when markets dip, the best assets go on sale. It's like snagging your favorite brand at half price. Volatility isn't the enemy, it's your shot to buy low. Want to keep it simple? ETFs and index funds are your friends. Funds like VTI, SCHD, or an S&P 500 ETF let you scoop up hundreds of top companies at a discount. No stock picking required. But if you're into individual stocks and want to get hands-on, now's the time to hunt for quality companies built to weather storms and thrive. Focus on 3 things that are profitable, low debt, and have a competitive edge. Think industry leaders you'd bet on for the next decade. ETFs or stocks, the goal's the same. Grab great assets while they're cheap. Now, if you're not there yet, if debt's piling up or you're investing on margin, hit pause. The last thing you want is to sell great investments at a loss because life hits or your broker calls in a loan. Instead, tackle high interest debt first, build an emergency fund, 3 to 6 months of expenses, and live below your means. Get that foundation solid and you'll invest from strength, not stress. Here's how pros see it. Volatility is not a threat, it's a gift. Buffett says it best, be fearful when others are greedy and greedy when others are fearful. Right now in 2025 with tariffs, inflation, and recession fears swirling, this is when long-term investors pounce. So reframe volatility like this. 1, it's normal, markets always swing. 2, you're not losing unless you sell. Paper losses fade when recoveries kick in. And 3, downturns are your wealth building moment. Buy quality, stick to your plan, and stay long-term. You don't need to be perfect, just consistent. That's how you beat the panic and build real wealth. Now let's get personal. I promised transparency, so here's what I'm doing in my portfolio right now. First, I'm sticking to my core ETFs, SCHD and VTI. I buy every day, dip or no dip. These are my long-term anchors. Second, I'm piling into the S&P 500 through my retirement account. Steady contributions every 2 weeks, no exceptions. And third, I'm using this dip to grab individual stocks with big rebound potential. Here are 3 I'm betting on. The first one is Advanced Micro Devices, or AMD. This AI chip giant is down right now, but with data centers and AI booming, it's primed for a surge. Number 2, Celsius Holdings. This energy drink rocket's revenue is exploding. Health trends say it's just getting started. And last, Supermicrocomputer. AI servers are its superpower. 70% of sales are tied to AI, and this has massive upside potential. That's my play. ETFs for stability, S&P 500 for the long haul, and beaten down stocks for growth. It's not fancy, just consistent. How are you handling this volatility? Drop your strategy in the comments. I'm all ears. Best of luck out there. Stay steady, and I'll catch you in the next one.